Welcome back to another edition of Intelligent Investment Today, the podcast concerned about the art of value investment as laid down by the man widely considered to be the father of the craft, the late great Benjamin Graham. In today's episode, we shall look into another topic focused around the investment style, which will constitute one more brick in the wall of knowledge and lead you to becoming a better value investor. This time we'll be considering if Warren Buffett can still be looked to and considered the value investor par excellence, or whether he's evolved into something different altogether. So sit back, put up your feet and tune into another scintillating edition of Intelligent Investment Today. Now, I'm going to hazard a guess here and say that the reason that most of us are here listening to a podcast about value investment will, somewhere along the line, have something to do with a certain Warren Buffett. This certainly mirrors my path into the value investment game, having stumbled across a biography of Buffett in my late teens that planted the seed that grew into this lifelong obsession with value investment, and particularly with Buffett's mentor and teacher, Ben Graham. Today's podcast is an inquiry into whether Buffett can still rightfully be described as a de facto value investor, given that his investment style has evolved so much from his early years as an investor and student of Graham. And if indeed he can no longer be described as a value investor, then what exactly is his current investment style? And how exactly does it deviate from the classical value investment training he received from Graham? In the early days of Buffett's investment career, it can be said that he was indeed a strict disciple of the investment style as espoused by his mentor. And it is probably possible to pinpoint the exact moment, by and large, the slow evolution away from Graham's strict investment criteria began. This was in 1959, when he met the man who would go on to become his partner and number two at Berkshire Hathaway. We are, of course, talking about Charlie Munger. Munger, unlike Buffett, was not a disciple of Graham, and investment-wise had a very different outlook. Whilst Graham believed that almost any business could be bought for the right price, no matter how good or bad the company's prospects or economics were, Munger believed that quality was the key. He believed that it was better to pay a little too much for a business with great prospects than to purchase a poor company for a bargain price. On this score, it can be said that Munger was the yin to Graham's yang. While Buffett was instantly impressed with Munger from the outset, it would take many years before his investment strategy would rub off on his friend and confidant. The change in Buffett's investment style was very much an evolution rather than a revolution. Whilst up to the point of meeting Munger, Buffett had been an eager practitioner of Graham's cigar butt approach to investment. This was how Buffett described the purchase of badly beaten down businesses, valued at less than the liquidation value alone, comparing them to a discarded cigar butt discovered on the sidewalk. Yes, that cigar butt might be damp and pretty disgusting, but you do get a free puff out of it. The businesses that Buffett was attracted to in these early years were indeed pretty disgusting, but he did indeed get a free puff out of them, and some of the best returns of his investment career came during this early period. However, the issue was that a point in time arose when Buffett had way too much money to invest, and these cigar butt opportunities began to become less and less worthwhile for him. When Buffett only had a few $1 million to invest, then Graham's value approach worked extremely well, but increasingly he was finding that simply not enough deep value opportunities existed in which he could park his ever-increasing assets. More and more, he had to look towards the multi-billion-dollar corporate behemoths to find opportunities for his increasingly large portfolio, simply because investing in small businesses was no longer worth his time or effort. And when you're forced to seriously narrow down the number of businesses that are available to you to invest in, the chances of discovering an undervalued gem on intrinsic value grounds become smaller and smaller. This means that to find a home for his increasingly large portfolio, he would need to look to something other than the quantitative factors, and he would need to look towards something that Graham had little time for, and that is the pursuit of chasing future growth. And this is where Munger's ideas and theories came in. Munger believed that future growth could be predicted through the qualities demonstrated by the business. In other words, the qualitative factors inherent in that business. These are things like the quality of the management team and any moats around the business that protect it from competition, such as any durable competitive advantages. In simple terms, Munger's investment style was not in buying undervalued stocks, but in purchasing stocks currently trading somewhere near their correct current valuation, believing that if the business was good enough, then the value of the business would grow over the long term. So I think it's pretty fair to say that Munger was certainly a growth-orientated investor, and this too is what Buffett has slowly but surely become over the years. A perfect example of Munger's style and how it rubbed off on Buffett is with the purchase of See's Candies by Berkshire Hathaway in 1972. Buying the business was, at the time, Buffett's biggest ever acquisition, but he was initially very reluctant to pay what seemed to him a steep premium over the business's intrinsic value. And there was certainly no margin of safety to be seen here. The $25 million paid was around 3 times its book value and 6 times its earnings. But Munger convinced him to think differently to how he had in the past. He persuaded Buffett to look past the intrinsic value and look at what a wonderful business See's was. Because of the strength of its brand, it had been able to raise prices year after year without losing customers. Quite simply, if you wanted to impress your date or your partner and prevent your dinner being fed to the dog, you would have to buy them See's as opposed to some lesser brand, whether that box of candies cost $2 or $8. It was a fantastic competitive advantage to have, and history has proved that Munger was exactly right on this one, with the purchase of See's going on to be one of Berkshire's most successful. So where Munger differs from the typical growth investor is this. The typical growth investor looks towards the general market to judge if a business is likely to grow in the future. If an investor buys a stock of Tesla, say, they are probably making a play that they believe electric vehicles are the future, and therefore Tesla, as one of the main players, are well placed to profit from this growth. Munger would not think in this way. He would be concerned rather with what specifically makes Tesla so great. He will be looking for any durable competitive advantages there that Tesla has to prevent other businesses from moving into their territory. If you look at most, if not all, of Berkshire Hathaway's stock purchases over the last few decades, it is the business and not the industry that Munger and Buffett have been concerned with. Take Coca-Cola, one of Berkshire's other biggest and most successful investments. Yet there is, and never was, anything especially attractive about the drinks industry as a whole from a growth perspective. It is well established, and sector growth is only ever going to be modest and gradual. But what Buffett and Munger saw in Coke is the fact that the brand is so ubiquitous and rivals few and far between. Globally, its only rival of note is of course Pepsi. But if you like the taste of Coke, Pepsi simply will not do. It essentially has a monopoly position if it is Coca-Cola you are really after. This means that even in the absence of sector growth, the scope to keep on increasing the price is very much open to the business. People are simply not going to switch to a rival brand for the sake of a few pence here or there, and these price increases can continue year after year. This is not the case with Tesla, who, despite operating in a much more exciting industry in terms of growth potential, it does not have a virtual monopoly position like with Coca-Cola. The sector is saturated with companies offering rival products to Tesla's, and whilst there might be a small few who feel that Tesla is the only brand for them, most will consider switching their allegiance if rival brands offer vehicles that they feel are superior or offer better value for money. So we can say that Munger is not a growth investor in the typical sense. Rather, he looks for individual businesses that have the qualities needed to allow the business to grow earnings year in, year out through the inability of rivals to compete. This is certainly not value investment, but neither is it de facto growth investment. So what investment style is it then exactly? I see it as a form of intelligent investment, but rather than the emphasis being on the quantitative data, in other words, the profits, the balance sheet, etc., as is the case with value investment, its main focus is on the qualitative aspects of the business and asking the question what attributes the company has to allow it to keep on raising prices ahead of inflation year after year, and does it have an inherent protective moat to prevent rivals competing with it now and in the future. Only once these attributes have been identified will Munger then look at the quantitative information to ensure the business can be bought at a reasonable price. So whereas value investors will look to underpay having decided what a business is worth based upon the profits and the financial situation, and then look towards the qualitative factors to ensure that there does not exist things that will destroy the valuation they have arrived at, investors like Munger will do the opposite. They arrive at the conclusion that a business is a great one based on its inherent qualities, and only then look towards the financial data to ensure they're not paying too much for it. Although a little too much might well be okay. So from this, we can say that Buffett has had to alter his investment approach from that of his mentor, Benjamin Graham, due to there being fewer opportunities to pick up seriously undervalued stocks, with the larger investments Buffett must now seek. It is through Charlie Munger's influence that this has taken the form of a sort of intelligent, qualitative investment style, seeking out large companies that are big enough to park the billions of dollars of assets required to make it worth his while. While these businesses are unlikely to be undervalued based on their current financial circumstances, by selecting businesses that are best placed to be able to raise prices without losing market share to rivals, then the chances of future growth are greatly enhanced. Buffett, it's fair to say, is no longer a practicing value investor, certainly not in his investments with Berkshire Hathaway. But whereas some might say this is a rejection of the teachings of his mentor, I would say different. Practical realities have simply made value investment a futile endeavour for him, given the size of the assets he needs to invest. Buffett has been forced to adapt into a Munger-style growth investor. I am positive if Buffett had to start out again today with a fresh canvas, it would still be value investment he turned to. For whilst Munger-style investment for growth can be done intelligently, it is certainly not an easy task. It requires excellent judgment. Value investment, on the other hand, is much more based on the facts of the matter, rather than mere opinions. And for that reason, value investment, if properly carried out, is more likely to succeed for all, not just for supermen like Buffett and Munger. Also, opportunities in undervalued businesses are likely to be much greater in number for the value investor. Brilliant businesses like Coca-Cola and See's Candies are few and far between. The vast majority of businesses, no matter how well they are run, do not have the protective, competitive advantages of these businesses. But nevertheless, if they are bought cheaply enough, can still make the investor plenty of money. Indeed, as the years have gone on, Buffett's results at Berkshire have increasingly mirrored the market as a whole. This, I'm afraid, is an unavoidable consequence of having hundreds of billions of dollars to invest. Returns on cigar butt opportunities, if made, would likely register similarly to a fart in a hurricane. On that note, ladies and gentlemen, I shall request, as ever, that if you've enjoyed the show, please do consider adding to your playlist. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.